I'm Jason Barber with Holistic Planning. I'm looking forward to sharing with you 5 tips that you need to know in order to have a $100,000 tax-free income in retirement. Stick around to learn more. Be sure to like and subscribe to our video today. There's going to be tons of great content, tons of great tips for things that you can learn to help yourself and help you do better with your money. Number one, first tip and thing to understand to have a $100,000 tax-free income in retirement. The most important thing is we need to understand how Social Security works in terms of how the federal government, how the IRS taxes your Social Security. This can be very confusing for folks because there's different ways that Social Security, different ways that the government can take away or reduce your Social Security benefit. Those can be if you take Social Security too early and you have earned income, they can reduce your Social Security. That's not really what we're talking about here. We're talking about, again, if you're fully retired, you're no longer working, you no longer have an earned income, and you have Social Security coming in, understanding how the taxation of that money works. There's also another way, which we won't really cover today. We need to understand how Medicare works, and that's a way that they can reduce your Social Security benefit by taking away a larger amount if you make too much money. That's a video for another day. So again, main thing to understand to have a $100,000 tax-free income retirement is how taxation of Social Security works. Lately in the political world, some political figures, I think Donald Trump has talked about the idea of potentially being able to make Social Security tax-free. That would be great if that happens. But until then, we need to understand how taxation of Social Security works. In layman's terms, the simplest way to think about this is that your Social Security is tax-free, but with an asterisk beside it, okay? So what I mean by that is it's tax-free as long as you don't make too much other money. And by other money, I would mean things like distributions from your IRA account, dividends off of stocks, earned income, of course, pension income, tax-free municipal bond income also, I believe counts towards this. There's a variety, rental income, mineral income, any other kind of income like that generally is going to count against you for taxation of Social Security. It's also important to understand, and we'll talk about this in a second, but also important to understand how the standard deduction rules work for married and single couples. That'll be point number 2. But Social Security taxation, think of it as it's like a sliding scale. As you start to make more money of these other kinds of income, then there's this slow scale where they start to tax your Social Security. Not take it all the way, but just include it as part of your taxable income. Now, there's currently a cap on the maximum amount of your Social Security that's taxable at 85%. For example, if you had $10,000 of Social Security gross coming in, the maximum amount that would be taxed is $8,500. But again, think of it as if you retired and all you had was Social Security income and that's it, you would pay no taxes on that. But then as you start to make too much other money, then the government will start to tax you on that Social Security income. The point number 2, understanding how the standard deduction works. Now, the standard deduction is, again, the simplest way to think about that is there's a certain amount of income, depending on if you're single or married, there's a certain amount of income that, let's just use a married couple, for example, can make and pay no income taxes. And so the standard deduction, I believe in 2024 is somewhere around $30,000 roughly. And it depends on your age and if you're over 65 or if you're blind, there's a lot of different rules like that. But just for easy math, $30,000, just call it the back of the napkin math. So you think of it as, okay, so the first $30,000 of taxable income that I make, the tax rate on that is 0. I don't have to pay any taxes on that. That's the next, again, very important thing to understand in the goal or the quest for having a 6-figure income and paying no income taxes. Now, point number 3 that we want to understand a rule here. In order to make this work in the long run, in order to make this work, one of the guidelines is that we have to be able to control how much income we get that counts as income that causes our Social Security to become taxable. One problem that a lot of people we see that we run into with a lot of folks is that they end up having too much money. I know this is going to sound a little strange, but they have too much money in their traditional pre-tax, whether it's a 401k plan, pre-tax IRA account, etc. Let's just say, for example, that you retire, you've got $1 million in your old 401k plan at work. That's a great problem to have, but one of the things that you'll find is that you have to pay money, you have to pay taxes on that money as you're drawing it out. Now, I'm jumping ahead a little bit here, but just follow me. If you can control the amount of pre-tax money that you're getting, and this is again assuming you've already taken Social Security, then let's say you could limit it to $1,500 a month. And again, back of the napkin, $1,500, $2,000 a month, somewhere in that neighborhood of income that is, let's just call it ordinary income. And that would be income, again, dividend income, IRA income, pension income, wherever that source is coming from. If you can limit it to somewhere in that $1,500, $18,000 to $24,000 a year of income, then that is going to allow you to pay minimal amount of taxes on your Social Security. As you start to go above that figure, above that $1,500 to $2,000 a month figure, it's going to be progressive that you're going to have to start paying more taxes on your Social Security. The ultimate math, the way this works, and again, I'm going to create just a hypothetical scenario here that would be maybe you would think of it as if I was as a financial planner, the few times that I can think of is, hey, I painted my Mona Lisa here. This is what it would look like, is that you would have a married couple, and let's say that they are in their mid 60s and they are taking Social Security. And we've got, say the husband's got a $3,000 a month Social Security check, and the wife has got a $2,000 a month Social Security check. So maybe between the two of them, call it roughly $5,000 a month. Could be that kind of a scenario. Could be that the husband worked and the wife didn't work, and then the wife is still entitled to half of the husband's Social Security check. But however the math works out, let's say that they've got roughly maybe $6,000 a month of Social Security income that they're drawing. And then let's say that they've got old 401k, pre-tax investment account, maybe it's a pension account. Wherever that money is coming from, again, they're in control of how much money they're drawing from this pre-tax account. And so let's say that they're taking let's just use the math and say $24,000 a year. So here they are, they've got $60,000, let's say, from Social Security. And then just for easy math, let's say they've got $20,000 coming out of a pension or a pre-tax investment account. So those two add up to $80,000. Where's the other $20,000 come from? If that extra money, that supplemental money, is coming from a Roth IRA, for example, we don't pay any income taxes, and that Roth IRA distribution is tax-free, and it also does not cause you to have to pay taxes on your Social Security. That's one of the only types of income that you can get that's totally tax-free. Completely tax-free doesn't cause, you don't have to pay taxes on that distribution, nor does it cause your Social Security to be taxable. So the formula would essentially look something like, hey, if I've got $60,000 of Social Security income, $20,000 of pension or IRA or dividends or whatever that other ordinary income or dividend income might be, and then the balance of the income is coming from the Roth IRA account, you can see how all of those numbers add up to $100,000 a year. And that's the dream. As I said, that's like the chef's kiss scenario there for a retiree would be, and that's my personal dream and what we help people all day long with, if at all possible. I want to have a 6-figure income in retirement, and I want the government to think that I'm broke. I want it to look like I have no income and I'm paying no taxes. And that is the ticket there. Key in order to make that happen is, like I said, it all comes down to this control over that middle category of income. If I can control how much income I'm getting from there, I can control how much my taxes on my Social Security are. I can control the overall outcome of my income taxes, which is really what we're looking for. So, what are some things to avoid if we want to try to control that? We want to try to not have too much money in our pre-tax IRA, pre-tax 401k investment account. Why? Because if you have $2 million in an IRA account, when you turn 73, or depending on your age, when you hit the required minimum distribution age, whatever that age may be, depending on when you were born, that required minimum distribution is going to be somewhere around 4.5% in the first year. So if you've got $2 million in an IRA account, whether you like it or not, you're going to be taking out almost $100,000 of ordinary income from that retirement account. When you take that $100,000 out, that's going to also cause you to have to pay taxes on your Social Security, whereas you would have otherwise not had to pay taxes on your Social Security. So you can see here how you can lose control over your taxes, and that can cause you to end up having to pay taxes not only on the IRA distribution, but it can also cause you to pay taxes on your Social Security that would have otherwise been tax-free. So that's a big thing that we'll help people with, is especially it's very good if you decide to retire early, you could potentially use that to your advantage. And this would be, I think, our fourth tip would be, if you retire early, say you retire at 60 or 62, you could consider delaying your Social Security and either distributing or doing Roth conversions on that pre-tax balance of that old 401k or pre-tax IRA account. You start doing Roth conversions on that money to get even on the taxes at a relatively low rate of tax, build up that Roth IRA account balance and reduce the pre-tax balance so that your future required distribution is a lot smaller. You can control the taxes on that. And also, by delaying your Social Security, you're getting an 8% increase every year that you do that. That's another way to, again, you're getting an 8% increase on an investment account, your Social Security account, that could be, if we play our cards right, tax-free 8% increase, which is also another big advantage. Last point real quick that I'll make, and then we'll wrap it up, is that we want to make sure, again, along the lines of being in control of our income. One very big mistake that we see a lot of people make is they will own actively managed mutual funds inside of a non-retirement account. If you have a joint account, a trust account, an individual account, a brokerage account, whatever the account may be, but it's an after-tax investment account, you really want to try to be in control of your capital gains and your dividends inside of that account. And unfortunately, actively managed investments, actively managed mutual funds in particular, have what we like to call phantom capital gains distributions. So these are distributions of capital gains that happen whether you sell the investment or not. And what that can do is that can cause you to be in that, potentially in the Medicare penalty box, but worse, it can cause you to have to pay taxes on your Social Security, even though you never actually sold anything. So we want to try to be in control. We want to control how much money is coming out of our IRA. We want to control how much capital gains we're getting, how much dividends we're getting, etc. And so the idea is, again, to summarize, we get our Social Security. We try to get as big of a Social Security check as we can get. That Social Security being mostly tax-free if we play our cards right. We control the kind of ordinary income that we're getting. We try to keep it around that $20,000 a year figure, plus or minus a little bit. And then the balance of the money that we need is coming from our Roth IRA accounts. Merge those three together, we can find ourselves with a six-figure income and a tax bill that's zero or very close to zero. And that, my friends, is what we like to call the Mona Lisa of financial planning. So that's a great thing and definitely something that we want to do for you. Again, subscribe to our channel, like the video, and be sure to go to holisticplanning.com, where you're going to be able to set up an appointment and learn more about what we do and how we can help you pay less taxes in retirement.